Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I look outside of the S&P 500 at other sectors, other indexes, to try to get some clues as to what's happening in the S&P 500. We also look outside of the stock market at other markets like interest rates or bonds. We look at commodities just to get some clues as to what's happening in the market. No index, no stock exists in a vacuum. And sometimes we can get some clues as to what's happening in the S&P 500 and even in individual stocks by looking at other markets. Another thing that we look at in this video is valuation. We look at that on a historical basis, and then I also look at it on a forward basis. This is being prepared for Monday, April 15th. The first area is S&P 500 valuation. This first chart looks backwards, historically, at what earnings were, and it compares it to the current price at that time and then right now of the S&P 500. Plotted on here is a PE ratio. When we get to a PE ratio of 20 or above, stocks are considered to be expensive at that point. When they're at 15, they're considered to be fairly priced. When they're at 10 or below, that's considered inexpensive or cheap. The black line is the S&P 500, and even though we had a down week, we're still well above this red dashed line with a PE ratio of 20. So you can see, and also looking back over time, that the market is considered to be expensive on a historical basis. Now, we can stay in this kind of a situation for years, so we don't necessarily use this to make decisions. We just want to be aware of this more from an informational standpoint. Then on the bottom, I have the spread between the current price of the S&P and the PE ratio of 20. We also can compare this to other major events that have happened in the market going back to 1980. We had the 87 crash, the dot-com boom and then bust, the housing crisis, the COVID plunge, and then where we're at right now. And then what were the trailing PE ratios at that time? We also can take a more smooth approach by using a method developed by Robert Shiller called the Shiller PE ratio. You may also know this as CAPE, C-A-P-E. This takes more of a smoothed or averaged figure for the earnings over a period of time to hopefully get more insight. It tries to take out outliers, or it's looking more for trends. Well, currently, the Shiller PE ratio is coming in at 34.02. To give us some context, we can look at that on a historical chart of the S&P itself. We also look up here in this red box where we can look at the median and the mean, where we're just at about 16 for the median and about at 17 for the mean. So looking at the current ratio, or the current ratio, it's 34.02. So it's almost double what it has been historically. The market doesn't do that. The market looks forward. And not only do I look at the forward-looking PE ratio for the S&P, that's the red line, but we also look at the mid caps and the small caps, and then it's marked up as well here, times that we were in a recession, times that we were in a bear market, times that we had corrections. And this is coming down because the S&P is coming down, but the current ratio that we're getting is 20.6. So we're just a little bit above that 21 level. So even on a forward-looking basis, stocks are in the S&P are considered to be expensive. But when you look at the mid caps, we're coming in at 15.9 and we're at 14.9 for the small caps. So the mid caps and the small caps are more fairly priced currently. Another area that we look at is growth versus value. And this played a big role in 2023. It's played roles for many years, but it was very helpful to give us some insight as to what was happening as the market was recovering in 2023. When growth outperforms value, the market tends to go up. When the market gets more defensive, like we saw in 2022, value tends to outperform growth. And it doesn't mean that value is going up. It may just mean that value is going down less than it is growth. Growth are the stocks that everybody likes to buy, the NVIDIAs, the Microsofts, the Amazons, the Googles, and so forth. Value are the real boring companies that have just stood the test of time. They may have more of an established base. Their balance sheets are usually a little more under control, but they're not what you hear about every day in the financial news. The first thing that we look at is a pure growth index. And this is in an uptrend, but we have been pulling back and we're coming back down to the moving average. We're seeing a lot of that. The market's at a real convergence zone right now on different indexes and even within indexes to decide, are we going to bounce up off of the 50-period moving averages or are we going to fall underneath that? And if you watch the other videos that I post, the daily video, the weekly video, you'll see that there's a real convergence going on right now. We also look at a pure value index, which this is actually dropping below its moving average, as lately growth has been outperforming value. That's where we get some real insight. And we do a ratio here, growth versus value. When this is going up, that means growth is outperforming value. Then I do an inverse of that same chart showing how value has been underperforming growth. And if we're going back into a more 2023 type of an environment where inflation is a concern, interest rates are a concern, we really want to keep an eye on growth versus value. It looked like we were trying to gravitate over to a new type of an environment where it was okay for interest rates to go up. It was okay for commodities to go up. They weren't being seen necessarily as inflationary. Well, we've been getting a lot of stronger than expected economic reports lately. And so the market is shifting back into this idea that good news is bad news as far as economic reports are concerned, and bad news is good news. Now that can change at any time, but we're just seeing kind of a general shift back to the different scenario. Then we look at growth to value in a number of different ways. We have some ETFs showing how growth is outperforming value. This is an inverse showing how value has been underperforming growth. We look at a longer term look at the same pure growth index showing how growth is outperforming. And here's an inverse. When this is going down, that means growth is outperforming, or to say it another way, value is underperforming. Then here's another look at an index showing how growth is outperforming here as well with this ratio. Then I use some ETFs to also show how growth has been bouncing back up. And this could be positive for the market, at least in the short term anyway. And this chart is also showing how value is underperforming growth. Then we look at, on a little more of a specific level, we look at small cap growth to value. And that's what we see on this chart, where we had broken out and then we started to see some weakness. It's coming back up. Even though it did decline on Friday, it's been holding up a little better as the market's been under pressure. Doesn't necessarily mean the index is breaking out. In fact, it's going down. But we want to keep an eye on this, because if there's a real strength in the growth to value ratio, that could mean that there's underlying strength in the index itself. And that applies to the mid caps as well, where we had been falling back, but we were starting to bounce back up. We're also still in a longer term uptrend here. Where it's most important from my view is when we look at a growth to value ratio for the S&P, where it is in an uptrend. It had been really going up, and we saw that confirmed by the index. It's to drop back a little bit. When we were going down with the growth to value ratio, this was after the October lows and the S&P was really going up. The market was trying to adopt this scenario that we don't care what it, well, they never say that, but we're not as concerned about interest rates. We're not as concerned about commodity prices. The Fed's going to come in and they're going to cut interest rates. Well, then all that kind of got thrown out the window at the beginning of 2024. Then the market was starting to adopt that a little bit more as well. And when we were really going up, we saw the growth to value ratio going up. Now it has been pulling back. If we are dropping back to this late 2023 type of scenario, to be more positive, we want to see the growth to value ratio going up. We keep an eye on inflation. This is a CRB index, which measures commodities. And this is a monthly chart where it's above the moving average and the moving average is turning up. So longer term, this is in an uptrend. We also keep an eye on inflationary versus deflationary areas of the CRB index on a monthly chart. We are coming back up, which is causing a little bit of a concern, but we're still below a declining moving average. So longer term, things are okay for right now in that aspect. On the daily chart, we just saw a recent golden cross, and the CRB index has been going up. We look at the Baltic Dry Index. This also helps us a bit with inflation. There are folks that shift things forward, like the S&P versus the Baltic Dry Index. I don't do that. I just look at where it's at right now. where this actually has been falling back a little bit, even though it's still in an uptrend. When this is going up, that tends to be more inflationary. So we'll be keeping an eye on this one. Some other markets, aluminum, which is now starting to cross over positive and is, after having been in a downtrend, is now starting to go in an uptrend. Corn is continuing to be in a downtrend. Wheat is also in a downtrend. Diesel has actually been declining as of late. Oil has been really going up, and now this has to do more with geopolitical tensions that are going on right now, specifically between Iran and Israel. I'm recording this over the weekend, and there's been some threats of Iran attacking Israel. We'll have to see how all that plays out. Now, when oil goes up and the oil companies are making more money, that can help the indexes go up too. But because oil's going up due to unrest, that tends to be more negative for the market. So currently, as oil's going up, that has been pressuring stocks. Gas is also going up and is in an uptrend. Diesel is kind of chopping more or less sideways. It did go up in the latest reading. And heating oil is pretty much going sideways as well. Natural gas just keeps falling more and more and more. It can't go any lower. It can't go any lower, and then it goes lower. Copper has been seeing a real upward move lately because we're seeing stronger than expected economic reports. When copper's going up, that means that it's looking more positive economically going forward. Then we look at a copper to gold ratio. Even though copper's been going up, gold's been going up even more, and that's why we're seeing this ratio going down currently. Here's a longer term look at that same ratio. I also plot the 2-year and the 10-year on this chart. As interest rates have been going back up, this ratio has been going down. We look at the gold ETF, which is really breaking out. You probably heard about it. It's in a lot of the financial media right now. But this is a little bit concerning, especially in Friday's session. It's been in a more sustained uptrend. Well, in Friday's session, we opened higher, set a high, and then ended up closing almost at the low. We gave back almost all the gains and then ended up being down for gold. It's very volatile. Does this mean something? Is this some kind of a reversal that may be happening? We don't know. We can just go by what we see on the charts. Silver also has been going in an uptrend and been doing really well lately, but gave back a lot of the gains on Friday and ended up finishing down. We look at the closing values for gold on the top, the closing values for silver in the middle, and then we do a correlation between the two. Now, it would only stand to reason. If gold's going up, silver should be going up. Well, when that's happening, we see a real high correlation between them. Sometimes they fall off a little bit, but right now, their correlation is pretty strong. We look at a gold to silver ratio on top. When this is going up, gold is outperforming. When this is going down, silver is outperforming. And then we plot the US dollar index, which has really been going up. And sometimes there's a high correlation between the top chart and the middle chart. Right now, there's not. They're more neutral with each other. The dollar has been doing really well lately and is in an uptrend, both on this daily chart as well as the weekly chart. This is a longer term look where we're finally breaking out above this downward sloping trend line. The euro has been under pressure compared to the dollar, as the dollar's been really showing some strength lately. And the Japanese yen, it's really the only thing in a downtrend right now compared to the US dollar. We look at the euro, which we're getting ready to see a cross here, but it hasn't quite happened yet, where the euro's been really weakening compared to the dollar. The Japanese yen is more in a sustained downtrend. The British pound also showing some weakness, could be getting ready to see a death cross here, but not quite yet. Then looking at different indexes, in Friday's session anyway, the equal weight, which is the red line, that's the broad market where all stocks in the S&P are treated the same. It really underperformed. And it's not like the weighted part of the S&P 500, which mainly is the Magnificent Seven. It's not like they did all that well either. It's just that they held up better than the rest of the market. Then we look at the equal weight and we compare it to the S&P 500. When this ratio is going down, that means that the broad market is underperforming the stronger stocks. We look at another ratio between stocks and commodities, showing that we have been pulling back, but stocks still are in an uptrend compared to commodities. There's an inverse of that same chart. Commodities have been bouncing back up, but they haven't crossed over yet with this ratio to look more positive. We look at the NASDAQ 100, which has been doing really well, but seeing some recent weakness, and the S&P 500, which also has been doing well, but seeing some weakness. Well, when you compare the two, the NASDAQ 100, even though it's been pulling back, it held up a little better this past week. We look at the S&P 100, and it's really been outperforming the rest of the S&P 500. The S&P 100 are the biggest stocks in the S&P 500. The NASDAQ and the S&P 500 both have been doing really well. They continue to be in an uptrend, even though we did see some weakness. Now we're starting to see the NASDAQ outperforming the S&P. The NASDAQ 100, which had been outperforming the NASDAQ, it's now pulling back as we're seeing a little bit of weakness here. Both have been doing really well. Both are just recently setting all-time highs, but this ratio has been coming down. We look at the mega caps, the really big monster companies, and compare it with the equal weight index. When this is going up, that means that the mega caps are outperforming. And we look at a ratio with small caps to the S&P. That's the red ratio, the red line that you see here. When this is going down, that means small caps are underperforming. The blue line is the S&P 500. We also look at another ratio showing how small caps continue to underperform the S&P 500. We look at the 30 biggest software companies. They are in an uptrend, but they fell below their 50-day moving average and coming down and possibly hitting their 200-day moving average. The mega caps are pulling back and coming down to their 50-day moving average. They haven't broken below this at least yet. Robotics and AI, that's an ETF. It's all the craze right now. It has been in an uptrend, but lately it's been pulling back. When we compare it to the tech sector, it's been starting to outperform, but it came right up to this longer moving average and now has been pulling back. So lately it's actually underperforming the tech sector. We look at the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them all together. The strength that we've been seeing is really from the Dow, but the Dow's been under pressure. The transports have been going sideways and the utilities are in a downtrend. So since the Dow's been pulling back, that's why we're seeing this coming down, but longer term, this is still in an uptrend. We look at the S&P 500 and we compare it with short-term bonds ranging from 1 to 3 years. And these are bonds based on price. And we are coming down a little bit, but longer-term stocks are still outperforming shorter-term bonds. We look at the S&P 1500, which is a broader measure of the market, and also compare it with shorter-term bonds. It's coming down, but is still in a longer-term uptrend. We look at another broad market measure and compare it with 3 to 7 year bonds. We're going a little further out. This is pulling back, but still in a longer-term uptrend. Then we look at an ETF. It's called the Total U.S. Stock ETF, and it has 2,651 stocks in it. It's coming down, and this is another convergence area. We're getting really close to the 50-day moving average. If we bounce up off of that, that could turn things back more positive for the whole market. If we fall down below this, that will undoubtedly turn things more negative. We look at the low volatility ETF, which by itself is in an uptrend, but when you compare it to the S&P, it's really underperforming, both on the daily chart here and on the weekly chart. We look at the tech sector and compare it with bonds. This is just showing that the tech sector is continuing to outperform. Then we look at some other stocks, and I show this in the daily video. This is the advanced decline line studies for the NYSE based on common stock, where we are seeing some weakness, but it's still above its moving average. Also some weakness with the S&P, the mid caps, where the small caps have actually fallen below their moving average. We look at Dow theory, where we were setting recent all-time highs with the Dow, but that was not being confirmed by the transports. They've been really underperforming. So that's a Dow theory non-confirmation. I also include utilities as part of Dow theory, and they've been under a lot of pressure lately as well. We look at the transports by themselves, where the Dow's been doing well up until lately, but the transports for 2024 have pretty much been going sideways. And we look at a ratio between the transports and the S&P. When this is going down, that means the transports are underperforming, and that is what they are doing. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. When this is going down, which it's come down a little bit since the Dow's been under pressure, we've seen this ratio fall just a little bit, but not anything really big as of yet. We look at a relationship between the S&P 500 on top and the transports, and they're having a fairly strong tendency to go in the same direction. It could get stronger, But basically that means if the S&P is going up or down, the transports are probably going up or down at the same time. Then some folks think that maybe Dow theory is a bit outdated. The Dow is only 30 stocks. It's not necessarily a representation of the US economy. So why not use the S&P 500 instead? And instead of using the transports, why not use the NASDAQ? That's more tech. Well, so I created this to give you some ideas just in a different way, where the S&P is coming off of recent all-time highs. And we were seeing a negative divergence, but it was finally confirmed when the NASDAQ went back and sent recent all-time highs as well. Then a little bit different slant. Instead of looking at the S&P 500, we look at the equal weight S&P 500, where it's been falling back lately. And then the NASDAQ 100 represented by the QQQs, which they have the big stocks in there. But we look at an equal weight ETF, and this has been falling back as well lately. So we've been under some pressure. The Wilshire is coming right down to its 50-day moving average. This is another broad market measure. This is another thing that you can add to the list of things converging as of this weekend. The FANG index, it looked like it was starting to break out. Then in Friday's session, it was under some weakness and it came back down. Longer term, it's still in an uptrend. And I'm keeping this chart around just in case we really see some weakness here to look for possible areas of support. It had been resistant, so if we really start to come down, this may end up providing support. ARK is still in an uptrend, but really been pulling back lately. And it never did really participate in the big run that we've been seeing since October of 2023. This is a monthly chart of the S&P 500 and then a ratio with stocks that are in Europe, Australia, Asia, and the Far East. When this is going up, that means that the S&P is outperforming global stocks. When we're above the moving average, that's also positive, and the moving average itself is going up and price is above the moving average. So the S&P is outperforming. We also plot an oscillator down below, and this is going up, showing that the momentum is positive. Then we look at total bonds based on price, where they have been under pressure, but they're still in an uptrend. This is a world bond index where they're also still in a kind of a shaky uptrend, but they have been falling back lately based on price. On a monthly chart, we look at stocks outperforming bonds. And then this is an inverse with a daily chart looking at how bonds are underperforming stocks. These are high yield corporate bonds. This just means junk bonds. And they've seen some weakness. This tends to follow more what the S&P 500 is doing, but they have set recent all-time highs, but lately they've been under pressure, but they're still in a longer-term uptrend. We also look at investment grade bonds. These are more conservative bonds where they are in an uptrend, never came back to their all-time high, but have been seeing some weakness lately based on price. Then we do a ratio between riskier bonds or junk bonds and more conservative bonds. When this was going down, that means folks were getting out of the riskier bonds and getting into more conservative bonds like government bonds because they thought maybe rates had topped out and we were going to start going down. When this is going up, that means there's uncertainty about interest rates. And so folks are getting back into the junk bonds because they give a higher yield. They're willing to assume more risk to get the return on that investment. If we finally top out with interest rates and start to come down, then we would start to see this ratio come back down. We look at a correlation between stocks and bonds, and they're having a slight tendency to go in the same direction, but it's not really strong right now. The higher this reading, the stronger the correlated relationship. Then we have a neutral area, and then down on the bottom, this is when they're moving in opposite directions of each other. We look at the corporate bond index, where it's still in an uptrend, but seeing some weakness. But really, for most of 2024, it's been going sideways. This is the 10-year yield with some Fibonacci retracement lines on it. We did hit the 5% level and then started coming down. We're starting to go back up now with interest rates, wondering, are we going to get back up to the 5% level? This is a longer-term look showing what the environment was like for 40 years, going back to 1980. Now we're possibly seeing a shift into a higher interest rate environment. And this is a chart I've been showing for quite a while, really since last October, because we hit a really low level and then interest rates seemed to be more under control. Stocks really started to go up. And this was, as of that time, that the market was anticipating a soft landing and that the Fed's going to cut interest rates 0.75% in 2024. Well, this has actually changed away from that, gone back to it, and now possibly changing back. The reason I show this chart is this is considered something positive when we hit this really low level here. Well, the other two times this really extreme negative reading hit, these were negative things that happened. So you have two negative things and a positive thing. We don't know. Not enough has really happened yet to give us any clarity, and that's why I keep showing this chart. Then we look at the 30-year yield, not really at any fib retracement level currently. This is the S&P 500 compared to the 10-year Treasury yield, where stocks have been underperforming as for the most part, except in Friday's session, interest rates have been going back up. We look at 3 to 7 year bonds based on price and compare them with stocks where bonds are underperforming, but they did bounce back up in Friday's session. Here's the junk bond ETF, just coming off of setting recent all-time highs and still in an uptrend, even though it has had some weakness as of late. This is a junk bond ratio to government bond ratio. When this is going back up, that means that junk bonds are outperforming. And we look at an ETF at the 7 to 10 year bond based on price, where it's been under a lot of pressure lately, dropping below its 200-day moving average. The RSI is turning back up, but it's below 50, and the momentum continues to be negative for the price of bonds. Then this is a daily chart of yields where we have been going up lately, but we did fall back in Friday's session. There's a weekly chart looking internationally with the US, UK, and German rates, and then the Japanese rates, which are still quite a bit lower, but they went up this past week. We look at a thing called the MOVE index, which measures the volatility of bonds. And as bonds have been under pressure, volatility has been picking up. As stocks have been under pressure, we measure this by using the VIX. Volatility has been going up here as well. Their correlation, it had been stronger, but now we're starting to see that trailing off a bit. We look at a monthly chart of the 30-year bond based on price, where it's still in a longer-term downtrend. When we compare it to the CRB or commodities, it's still showing that bonds are outperforming commodities. And we look at different sectors. And I changed this a few weeks back, where first I just look at the sector itself, and then I do a comparison of that sector with the S&P 500. And I just list this alphabetically according to their symbol. That's why materials comes up, because they have B at the end of their symbol, where they have been showing some weakness, but they're still in an uptrend. When we compare it to the S&P 500, it has been coming up, falling back, but it's still in a downtrend, showing longer term that it's been underperforming. Here's communication, one of the stronger areas, continues to be in an uptrend. It's also in an uptrend when we compare it to the S&P. So communication has been outperforming the S&P. Energy, which is falling back right now, but still in a longer term uptrend. When we compare it to the S&P 500, it is still in a downtrend, but it's really been roaring back since the first part of March as energy prices have been going up. The financials, which had been doing quite well, and now we're seeing some weakness. And then the earnings reports that came out on Friday were not well received. So we're seeing some weakness and actually dropping below its 50-day moving average, but it's still in a longer-term uptrend. And it had been outperforming nicely when compared to the S&P, but now is falling back, but the ratio is still in an uptrend. Industrials also seeing some strength, but now pulling back as the climate might be shifting a bit. And they're still in an uptrend when compared to the S&P, but we have seen some recent weakness. Tech sector going sideways pretty much for all of April, dancing around its 50-day moving average. And it's still outperforming longer term when we compare it to the S&P, but it has been seeing some weakness. The staple sector, which is in an uptrend, but has been pulling back, actually fell below its 50-day moving average. And when we compare it to the S&P 500, it's really been underperforming. So even though this is in an uptrend, it's still underperforming the broader market. Real estate, which has really been under a lot of stress on a comparative basis, it was doing really well when we thought the scenario was shifting. And then that scenario came into doubt. So real estate started to fall. Then they were starting to get back, be a little happier again. Well, we're still in an uptrend with real estate when you look at it by itself, but it is massively underperforming compared to the S&P. Utilities are in an uptrend when you look at them alone, but are really underperforming even though they bounced back recently when you compare them to the S&P. Here's a ratio. When this ratio is going up, that tends to give support to the S&P. Lately, it's been falling back and causing some pressure on stocks. Healthcare, which has been in an uptrend as well, now starting to fall back and is continuing to really underperform the S&P 500. We look at discretionary, the thing that makes life fun, things that make life fun. It's still in an uptrend, but seeing some recent weakness, and it's continuing to underperform. In 2023, when we saw some real nice moves up with the S&P, discretionary was doing a lot better at that time. And a lot of this has to do with Tesla. If we're going to be able to turn more positive, we need the discretionary to really come back up and outperform the S&P. Semiconductors coming right down to their 50-day moving average. You see this convergence happening here? The energy sector has been really underperforming the tech sector, but lately bouncing back up. It's actually breaking above the 200-day moving average with this ratio, but it's still in a longer-term downtrend on a comparative basis. And we look at growth and compare it with bonds, growth stocks, basically, which they're still outperforming even though they pulled back this past week. The tech sector compared to the 10-year yield, showing how the tech sector is still outperforming, but pulling back recently. Here's an inverse of that same chart showing how interest rates are underperforming the tech sector, but have been bouncing back up. Discretionary versus staples, pretty much going sideways, but discretionary still in a longer-term uptrend with this ratio. Here's an inverse showing how staples have been underperforming discretionary. We look at gold, which is what everybody's talking about, but it's still in a longer-term downtrend when we compare it to the S&P. It is breaking out when we compare it to the dollar, so that's actually broken above longer-term resistance. High leverage loans, which were down a little bit, but they haven't even come down to their 50-day moving average. These are very risky loans, and they continue to hold up quite well. NYSE Composite, a broad market measure, right down to its 50-day moving average. All stocks on a daily chart, down to its 50-day moving average. This is U.S. stocks as well as international stocks. Emerging markets pretty much chopping sideways, but are still in an uptrend. The Japanese Nikkei, that's their main index, after going back and setting all-time highs, we're just about at those levels again. The microcaps, small companies, are still in an uptrend, but have been pulling back recently. And then we look at the home builders. We're not really getting anything from this chart. I look at the S&P on top and the home builders ETF, and then I look at the ratio between them. What I really pay attention to is the correlation on the bottom. They're having a tendency to go in the same direction at the same time. Look at Bitcoin, which another thing that folks have been talking about, but it's starting to show some weakness. But longer term, it's still in an uptrend. We look internationally, where China's in a downtrend, emerging markets, Europe, Japan, and now even the US. This is the KST. It's a little different oscillator than what some of you might be used to. It takes longer for this thing to shift. We look at an InterMarket Analysis chart where we see oil, then gold, then stocks, then the dollar. Those are all positive going back to the beginning of the year. But when we look at bonds based on price, they are negative. Some correlations. We look at the correlation between the S&P 500 and the dollar. They're having a slight tendency to go in opposite directions. Dollar's been seeing strength. Stocks have been seeing weakness. That's why we're seeing them moving in opposite directions and seeing this correlation going down. We look at S&P to oil. Now, there are times when oil and the S&P can have a strong correlation and be going either up or down. Now they're having a pretty strong tendency to go in opposite directions because of the geopolitical tensions. And we look at the S&P to the 10-year yield, slight tendency to be going in opposite directions. And then tech to the 10-year yield, this is neutral now. Then we look at the S&P to the 2-year yield, slight tendency to go in opposite directions. Then we look at some long-term charts. This is a monthly chart of the NYSE. We're above the moving average, which means we're positive, even though we have pulled back lately. The Copic curve, which is a momentum oscillator, continues to be positive. Here's a daily chart of the NYSE with the record high percent index. It pulled back a little bit in the latest readings, but it's still quite strong overall. Here's a monthly chart of the S&P 500 above its moving average, even though we're seeing some recent weakness. Longer term, the percentage price oscillator, or PPO, continues to be positive, but it is rolling over just a little bit here. Then we look at a ratio between the S&P 500, which is positive on top, and the CRB index down below, showing how stocks are continuing to outperform. But this is a monthly chart, and so it can take a while for this ratio to shift. Then we look at the S&P 500 and compare it with global stocks, showing how the S&P 500 is outperforming, and the KST is turning slightly positive. Then at the end of this video, I make a list of all those things that are positive, and it's not everything that I covered. It's just the main markets here. And my definition of positive is when the 50-period simple moving average is above its 200-period simple moving average. And the list is quite long. There's only one thing on the negative list right now. Growth, value, they're both positive by themselves. Copper, the British pound, and the euro to the US dollar, but that could be changing. We're just getting ready to see potential death crosses there if we see more strength in the dollar. Gold, silver, they're in uptrends. The dollar index by itself is in an uptrend. The CRB index, the big software companies, the mega caps, the FANG index, ARC, the low volatility ETF, again, by itself, but when you compare it to the S&P, it's really underperforming. Staples, the composite average for the Dow, and all the bonds based on price. Even though they've been pulling back, they're still in longer-term uptrends. The tech sector, as well as the semiconductors, the high leverage loans, the Dow, the NYSE, and the Wilshire, those are two broad market measurements that I use. The NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps. All stocks, emerging markets, and then at the very bottom, for some reason you can't see it, should be Bitcoin. Then there's one negative thing here, and that's when the 50-period moving average is below its 200-period moving average. It's the Japanese yen to the dollar. But if we see more strength with the US dollar, this list might get a little bit longer, at least on a currency basis. Thank you. I really hope you found this helpful. Please feel free to check out some of the other videos that I post. I hope you have a great weekend, and I will talk to you in the next video.